The second myth then is, how then do you determine what's a good idea and when's a good idea to refinance? One of the biggest things everyone says is, if you just look at how much you drop the monthly payment, that's going to determine what your savings are and how long it takes to justify the closing cost. Not true. Many will say, if you drop your mortgage payment $100 a month, that means you're going to save $1,200 a year. If the closing costs are $3,000, you gotta roughly think it's going to be about 2.5 years before you actually make it worthwhile, right? It makes sense, and if you want to view it that way, have at it. But it's wrong. The way to actually do it is to calculate the interest savings on that mortgage. So what I want to do is I'll give you the very brief formula as to how to calculate the interest savings, something that's very useful and people just don't frankly use. And then I'll give you an example to make it a real world. Now first of all, you take the current mortgage balance that you have, multiply that by your current interest rate. That will give you the annual interest that you will be paying. Now look at the new loan amount, which is typically going to be a ballpark of your current mortgage balance plus the closing cost, plus throw in $2,000 for taxes and insurance escrow. So bounce it up $5,000. Take the new loan amount times the new interest rate, and that will give you the new annual interest. Now take the original interest minus the new interest. That will give you the interest savings. So a lot of words thrown out there. Let's make it more concrete with a real live example. Say you have a 30-year loan that you got out 5 years ago for $210,000. You've now paid that down $15,000. So good for you. The loan you currently have is $195,000 on say a 6% rate. Now in order to determine what your interest is that you're going to be paying for that year, you take that current loan amount of $195,000 and you multiply it by 6%, and that gives you an annual interest of $11,700, I think it comes to. Now, if you want to look at the new loan, you have to take a look at the current loan amount, bump it up by that amount that I had mentioned, the $3,000 plus the extra for taxes and insurance, and that gives you a new loan amount of $200,000. So now, you take that $200,000 and multiply it by your new interest rate of today, you can get 4.5% on a 30-year fixed rate, 0 points. So we'll go with that. Mind-blowing, yes, but we'll just use that as an example. So if you take that $200,000 times the 4.5%, that's going to give you annual interest of $9,000. So take the $11,700 you're currently paying minus the $9,000 that you will be paying if you refinance, and you get an annual interest savings of $2,700. Now, you take that $2,700 and compare that to the closing cost of $3,000, and it's pretty obvious that it's going to take just a hair over a year to truly recoup the cost of refinancing. And that is how you determine whether or not it makes sense to refinance.